Hey everybody, Marty Mazzora here. It's the 12th of December 2022, Tuesday, with a really brief market snapshot for you. We're going to look at the S&P, the NASDAQ 100 ETF, small caps, 10-year yield, the dollar, and gold, just like we've been of late. So I want to just kind of keep these charts live and updated and see how the technical picture as I see it is unfolding in each. So as I've said, I think a couple times recently, if it weren't for seasonality, I'd be as bearish right now as I was bullish going into November and as I was bearish late July. The market traded pretty flat going into today's CPI number. It was perfectly okay. We are seeing disinflation. We've been calling for disinflation ever since it peaked because we have a thesis that says the economy is ultimately going to slow markedly, and that's a very disinflationary, ultimately perhaps deflationary environment depending on the depth of the recession, if indeed we are going to see one in the not too distant future. We have, like 9 or 10 central banks meeting this week, but of course the big one is tomorrow. 11 a.m. Pacific time, Chair Powell is going to make the announcement that they're not budging the Fed funds rate, but the market's going to be listening to every word of the statement with bated breath and then every answer that he gives during the presser following their policy statement. So given the technicals, which we're going to review right here, there is the potential for a meaningful correction in the patterns, even during what could be a very good, Santa Claus season, if you will. But I think it would take a catalyst. An obvious catalyst would be a hawkish Fed tomorrow. So we'll see. I'm not predicting that, but given some of the latest rhetoric and so on and what the market's done of late, he could. I really don't think he's going to come in uber dovish, but I think the market would like anything that's not uber hawkish, if you will. Okay, so in front of you is the S&P 500 daily chart, and we have now moved up above that July high, as you can see there. So we've got this uptrend building in there, and you can see right here, I think we could have painted a rising wedge pattern, which is bearish, and you can see we're breaking above that. As of today, looks like the market closed right on the highs. Folks, we still have these long bearish divergences. That's quite bearish, both on the MACD and on the RSI, and the RSI is back notably into overbought territory. Like I said, it's just very heavy, very exposed, potentially out over its skis, if you will, right here. This is a high that would be divergent, if you will, relative to the momentum indicators. But seasonality is strong, no doubt about it. But as I said, this is not something that I'd want to back up the truck and buy into based on what I'm seeing right here. On the QQQ, the NASDAQ 100 ETF, one of my favorites, if not my very favorite technical analyst, a gentleman named Randy Finney, pointed out the striking comparison between the patterns right here on the NASDAQ 100 versus the pattern going into the all-time high back in late 2021. Yes, that is strikingly similar over the past few months, and ironically the same time of year as well. And to even add to that case, take a look at our momentum indicators. The MACD was rolling over after coming up strong from that level. MACD rolling over after coming up strong from the same level. RSI overbought, trending lower, bearish divergence. RSI overbought, call that a bearish divergence as well. Now, that's what technical analysis is all about, right? Finding patterns, consistent patterns in history that really are a representation of the underlying dynamics that investors are playing into. Sentiment, greed, fear, that sort of thing. This is what a greedy setup looks like, and it is confirmed by the sentiment indicators, and it looks the same. Does it mean that it's going to play out precisely like it did here and you get a 30% decline plus? Of course not. Doesn't mean that at all. It just means that this is what these setups look like, right, folks? Just like this was a setup that we were pointing way back then that actually was looking quite bullish, right? And we got a really nice pop, but then it morphed into something, right, that peaked out and was looking quite bearish. Then we formed that bottom. But remember, while we were forming that bottom, these were analyses we were doing at that time. And I said, odds favor a pretty good rally right here. And that has gone, save for a couple of spots, right, where we had some corrections that were flagged down in here, right? This one in particular in July. But yeah, so doesn't mean that we're not going to blow right through here with the Santa Claus rally and burn through these technical patterns. It just means that risk is really elevated right here. Small caps, the Russell 2000. I said this one has looked more constructive to me, right? We don't have bearish divergences, right? But we do have a rising wedge pattern right here. And we are, borderline overbought. So this is looking heavy to me as well. Looked like we might have closed down a little bit, at least down off the open today. Had a conversation with a friend earlier who made the point that, small caps are really rallying. And, that tends to be what happens as the market broadens out. And I said, absolutely. In fact, we are buyers of small caps in a not small way at the bottom of bear markets, particularly recessionary bear markets. It is fully our intent to be adding small cap exposure at some point in the not too distant future. But what I said to him is that, right now we have to view this as a counter trend bear market rally, given what we're seeing in general conditions. I will happily change my mind and I will happily buy small cap stocks up here or higher if conditions dictate that that would be a good idea. They don't dictate that now for us when we're managing our clients' long-term monies. Okay, so the 10-year yield, remember we've been painting this extended bullish falling wedge pattern against a bullish divergence in the RSI. Not in the MACD in terms of the lines, but the histogram is beginning to show us some hope there. And we did break out with a pretty strong candle and threatening to come back down and backtest that. If Chairman Powell comes out hawkish tomorrow, I think yields will go up. If he comes out dovish, I think we'll fall right back down into that wedge pattern. Right now, this looks bullish for yields. That should be relatively bearish for stocks. The dollar. We've had good luck with our technical analysis on the dollar for quite some time, and we got bullish right in here. And again, that's a headwind for stocks, and this still looks like a pretty bullish pattern right here for the dollar. Same thing though. If Chair Powell comes out hawkish tomorrow, dollar's going up. If he comes in dovish, dollar's going down. Okay, gold. Gold, we nailed right on the nose, and all we did is hedged our position in our portfolio. So remember right in here, folks, I was flagging a very bearish look for gold. Among a lot of real bullish sentiment, I told you that highly likely that this all-time high was not going to stick. And as you can see, that certainly didn't happen. That looks kind of like a bear flag that's played out almost perfectly. So like I told you already, we bought put options here to protect our position. They doubled the next trading day, so we rolled them down, still just below the money, and it continued to fall. Today, we rolled down to the money and collected back half of what we spent on the second hedge. So right now, that's been a really good position that's mitigated a bunch of the downside that gold has experienced. So we'll see. We've got that into roughly mid-January, and we'll decide based on what the charts and the macro setup dictates to us going forward. We do like gold long term. I will express why in our year-end letter. I just posted part 3. It'll come in an email to subscribers tomorrow morning. The next couple of parts over the next week or two will be painting our long-term picture, our view of the dollar, our view of commodities, our view of global equities and so forth, and why going into the next cycle. Our work right now says that we're late cycle right here. There's more to play out, and there's some not small downside risk in asset prices. So we want to be very cognizant of that, not worry about catching, every inch of the upside. We want to be there to catch some of it, but more importantly, we want to be there to catch less of a downdraft and be in a position to buy into it if indeed one occurs over the coming months. I'll leave it there, folks. Thank you so much, as always, for watching and listening. Talk to you again soon. Bye-bye.